So I think it's critical to reiterate that the fraud and financial crisis that we've seen with FTX in recent months is part of human nature and not necessarily related to the principles of crypto. And if you look back through history, you'll see numerous incidences of fraud and financial crises. Wikipedia's got an extensive list going back into the 16th and 17th century. The crises continue to exist even to this present day. And these repeated crises and cases of fraud can be put down to two primary reasons. The first one being human greed, and the second one is a banking technique called fractional reserve banking, which is what I'm going to go into a little bit more detail in this video. So unless it's specifically and contractually stipulated, an institution that takes deposits, client deposits, onto that institution, they have an ethical obligation to return that to the deposit holders immediately. As an example of an exemption would be something like an investment fund, where you contractually say that you're giving over those funds for the investor to do certain things with that money, and that you shouldn't expect them back for some period of time. Now, of course, with a bank and an investment exchange, deposit holders are expecting to put that capital to use whenever they want to, whether it be for buying goods and services or investing it into certain investments. And as a result, that institution has an ethical obligation to keep the capital on reserve. Now, what we've seen throughout history is that greedy human nature implies that many deposit-taking institutions throughout the history of the world have veered away from full reserve backing. The conversation goes something along these lines. A banking exec is sitting in his office and he's saying, listen, we have this big balance sheet. Look at all these millions of dollars that we have on deposit. We should really put these to use. They're just sitting idle there. And clients are never going to redeem them all at the same time. So the banking exec says. And so what they do is they take some client capital and they invest it into other investments. There'll be longer duration, there'll be higher credit risk, things like mortgages, equities, venture capital investments, or into crypto tokens. And so the party starts and the proverbial drug of finance is swallowed, which is fractional reserve banking. Because what happens as soon as that drug is swallowed, the bank starts to do more and more of it. They very rarely will just take 1% of client funds. They will use more and more because it seems like such an easy way to generate returns. So they use more and more client funds and they invest it into longer duration, higher credit risk assets. And this seems like a magnificent idea because the bank produces wonderful profits for shareholders and for themselves as executives. And in the short term, there doesn't seem to be too much risk because most of the time, deposit holders don't withdraw their capital all at the same time. But as with most parties, once this sweet elixir of fractional reserve banking is tasted, the bank just pushes it far too far. And I won't go into all the detail about economic cycles and liquidity cycles, but the truth of the matter is that these things go in cycles, that you do get these liquidity cycles, economic cycles, money supply cycles. And the good times do not last forever. Eventually, the liquidity starts to run dry and economic activity isn't as strong. The investment returns are not as strong. People start to keep more capital in cash. Some people might withdraw capital from banks to have more cash on hand. And so this starts to place a little bit more pressure on a fractional reserve bank that, just to confirm, has taken out client capital and invested it elsewhere. And then one day, a large deposit holder comes on and knocks on the door and wants to redeem a huge amount of capital all at once. And the bank says to them, don't worry, we've got your money. Just give us a few days and we need to liquidate this illiquid property investment, for example. And by that point, the game is all up because as soon as the rumor gets out that the bank doesn't have all of the capital on deposit, everybody else starts to run for the door. All the other deposit holders also want their money out because they don't want to be the last one at the bank when there's no capital left. And then the bank is quite clearly insolvent. It becomes a self-fulfilling prophecy as the deposits get taken out, and the bank at some point won't be able to deliver on it because they are technically insolvent, because the illiquid assets will drop in price during that liquidity event. And this is the age-old story of drug-addicted fractional reserve banks since the beginning of time, including FTX. FTX should have kept client deposits on reserve, all of them, but what they did is they started lending them out to their trading firm, Alameda. This is not only a hugely fraudulent activity, but it's exactly the cause of pretty much every banking crisis since the beginning of time. In the short term, this process of fractional reserve banking allows the large institution to feel very powerful. They appear very powerful, wielding their large balance sheet. But in reality, they're just a very large, leveraged investment fund that can easily get a capital call from their investors at any point in time. And that's exactly what has happened in November 2022. Well, so what can we do about this? Well, in traditional financial markets, the proposed solution is to have heavy regulation on financial services companies, financial intermediaries, as well as to have a central bank backstop on fractional reserve banking. So what are the prospects that we can have that heavy regulation and central banking in the crypto markets? And that's the detail I'm going to get into in the next video, explaining why these solutions are imperfect and potentially undesirable in crypto markets. I'll see you in the next video.